as we normally do on Your Money Matters, we talk about two things. And I would like to talk to you about a hybrid mutual fund scheme category that has been catching people's attentions. And this is the equity savings scheme. We often talk about the balanced advantage fund. We often talk about the multi-asset fund, which a lot of people have been putting into their portfolios recently. We don't speak enough about the equity savings scheme. My next guest is Pankaj Matpal, who is the founder and chief executive officer of Optima Money Managers. Pankaj, thanks so much for taking the time. Always a pleasure speaking with you. First, let's talk about what this is. What is the equity savings scheme?
Thank you, Alex, for having me on the show. See, as you said, these are hybrid schemes, and hybrid means there are more than one asset class. But especially about equity savings scheme, there has to be minimum 10% allocation in debt and minimum 65% allocation of the total asset of scheme has to be in equity. But when I say equity, not necessarily that you have equity, it can be arbitrage. So the gross equity will be above 65%, but if you say net equity, it may be much lesser. So it means you are investing in a hybrid fund where your equity exposure is much lesser, but because it has 65% or more in equity or arbitrage, so for tax planning perspective, it qualifies for equity taxation. It means if you invest in a hybrid fund where equity allocation is lesser than 65%, in that case, it will not qualify for long-term capital gains after 12 months. Depending on the allocation, it may not qualify or may qualify for 2 years. But if you are talking about equity savings scheme, here your investment after holding period of 1 year will qualify for equity taxation. It means long-term capital gain tax will be applicable at 12.50%. So tax the scheme is tax efficient. Tax is lower compared to the slab rates in most of the cases. And second thing, your actual equity exposure is less. So open-ended scheme, hybrid scheme having exposure to equity and debt, but equity taxation is applicable here.
Yeah, absolutely. And so therefore, you can also take that benefit of the 1.25 lakh rupees in a given year that you can book out in equity-related investments that is not taxed at all. So that's a benefit that you can gain as well. But I do want to set the expectations here, Pankaj, and it's important to do that. So if you're looking at investing in a scheme like this, as you pointed out, minimum 65%, which is in most cases, it's more than that, much more than that. So therefore, what is the return expectation? How would you benchmark something like this?
Exactly. See, there's a lot of flexibility in this category. So as I said, that your gross allocation in equity or equity-related instruments should be minimum 65%, but all the schemes in this category will not have that much exposure to pure equity. It is mostly arbitrage. So in this case, it depends on that what kind of allocation you have, how much debt, how much arbitrage, or how much cash, how much equity. So based on that, the returns will vary from one scheme to another scheme. But say in last 5 years, in last 3 years, there are 20 schemes in this category. And if I say average return, so in last 5 years, CAGR has been 11.50% as per yesterday's NAV. And if you talk about the 3 years CAGR, it has been 10.61%. In last 1 year, the absolute return is 6.21% average in this category. So again, means I'll repeat one thing, that past returns are not the indication of the future performance. Mutual funds returns subject to market risk. But yes, as you asked me, how much returns can be expected? This is the historical performance this category has shown.
Okay, but you mentioned that, Pankaj, that 65% minimum equity investment is not necessarily and quite often not through pure equity. There is also arbitrage, which is used by fund managers. And this is a safe option, relatively safe option. Of course, in the risk pyramid, you would have fixed income at the bottom, then you have arbitrage, then you have pure equity. So therefore, how do you differentiate between different schemes in the category?
Yeah, as you mentioned it, because gross equity will be 65%, but it's not pure equity. Most of the part is arbitrage only. So when you compare the scheme, you have to see multiple things. One is asset allocation. It means that how much asset is allocated in debt and how much in the gross equity, including arbitrage. That is one part. Because more the debt, it means compared to equity, you will expect lesser returns in long term. Second thing, within the equity asset, as it is divided between arbitrage and the pure equity, so how much that for equity allocation means spot market exposure is there in the scheme. Now, say your objective is to protect your capital, means you do not want to take much risk. At the same time, you want to have some better returns compared to debt. And yes, you want to take the tax benefit. So in this case, you will go for the scheme which has more exposure in arbitrage and less in spot market. Or if suppose you want to take a little higher exposure to spot market, in that case you can go that kind of scheme. So obviously, if your objective is to invest in equity saving scheme, does not mean that all the schemes are same. Similar to flexi cap or balance advantage fund, where there is so much flexibility in the hand of fund manager. Similarly, in this category, there is a lot of flexibility in the hands of fund managers. So when you invest based on your objective of investment and risk appetite, you have to choose the scheme. So not only returns, you have to see the risk as well in the scheme, like trainer ratio, Sharpe ratio, standard deviation. These are some important things you have to see before selecting one scheme.
Yeah, it's important that you've pointed that out. And by the way, we have discussed Sharpe ratio, the Sortino ratio, standard deviation, and how you should read all of them in past episodes. I'd invite you to have a look at it on our YouTube channel. And of course, in coming weeks as well, we will discuss this in more detail with examples. But Pankaj, I want to talk to you about the best performing schemes over the past 3 and 5 years. What has stood out about these, and which schemes stand out in these top performers?
Alex, as you know that every year that performance keeps hitting, sometimes that some schemes are in top 5, another year some other schemes will be in top 5. So first I'll read it for the benefit of investors. If I say last 5 years, the top performing schemes are like HSBC Equity Savings, Mahindra Manulife Equity Savings, Mirae Asset, HDFC Equity Saving, and Sundaram Equity Savings. In last 3 years, if I talk about HSBC Equity Savings, Sundaram Equity Savings, Kotak Equity Savings, Invesco India Equity Savings, and Edelweiss Equity Savings. Now, investors should not, or viewers should not get confused. You should see the consistency. The scheme may not be always a top performing, but there should be a consistency in the scheme that is more important. So here, for example, HSBC Equity Savings Scheme, Edelweiss Equity Savings Scheme, Kotak Equity Savings Scheme, and HDFC Equity Savings Scheme, these have been the consistent performer. And the other question that where the performance comes from, see, again, in every market, whether it's a debt or equity based on the economic condition, you have to see that what kind of exposure you want to maintain in order to maintain the consistency in the performance. So some scheme may be that when there's a rally in the equity market and they take higher exposure in spot market, obviously returns will be higher. But you have to see in this case, your risk is also higher because you are exposed to higher equity. So if your objective here to protect your capital in some way, means you do not want to take much risk on the capital, in such case, the scheme you select should have limited exposure to spot market. More should be arbitrage only, so that your risk is limited. At the same time, you are getting tax efficient returns.
Okay. Let's talk about purpose and who should consider investing in this, Pankaj, because often we talk about different age groups, and ultimately every instrument that we talk about has a specific purpose, is meant for a type of investor, and people should do it based on goals. But having said that, what is the ideal time frame that you should be willing to give if you are investing in an equity savings scheme, and who should invest in it?
It's a very important question, Alex. I'll say, see, first thing, these schemes are not suitable for wealth creation. So investors should not expect very high returns and should not be considering these schemes for long term. But ideal investment horizon should be 1 year to 2 years, something, because at least more than 1 year, so that your investment qualifies for long term assets. And second thing, not very long, because you are not investing in these schemes for the purpose of wealth creation. So 1 to 2 years is the ideal investment time. Second thing, this type of people means if you want, suppose, to get if you want to use this for SWP, that can be a good choice for a short term. For long term, again, there are some different schemes are there. Second thing, for asset allocation purpose in your portfolio, you want to have some exposure to arbitrage or this kind of fund, then it can be considered. Second thing, little more returns we're expecting compared to debt, and obviously post-tax returns are better. In that case, you can consider. And mostly when you are in higher tax bracket, when you are in 20%, 30% tax bracket, and you know that that investment will be expensive for you post-taxation, post-tax. So in that case, this can be a good category. So objective plus your investment horizon, both the things you have to see before going for this kind of schemes.
Last question, and this has to do with the balanced advantage scheme, which is also called dynamic asset allocation, which also shuffles between equity and fixed income, between 20% and 80%. But often I've seen that in most situations, it's more than 65% equity for that equity taxation. How do you divide between the two? How do you decide whether you want this or that between equity savings scheme and balanced advantage?
The equity exposure in balanced advantage fund is much, much higher compared to equity savings scheme. So when you invest in balanced advantage fund, or which is also known as dynamic asset allocation fund, your investment horizon should be more than 3 years. But in case of equity savings schemes, the horizon should be 1 to 2 years or less than 3 years. So one thing, based on the investment horizon, you can differentiate between two of them. Second thing, risk appetite, because when I say that your equity exposure in balanced advantage fund is more than equity savings scheme, and mostly much higher compared to that, in that case, obviously, your risk or volatility in the scheme will be higher when we say balanced advantage fund. So if you do not want to take the risk of high volatility, in that case, equity saving fund will be a better choice. So these two things, again, volatility and your investment horizon, that you have to see.
Got it. Pankaj, thanks so much as always for taking the time. Pleasure speaking with you.
Thank you very much.
And that brings us to the end of this edition of Your Money Matters. Let us know what you think and what you'd like to be discussed on this program. This is NDTV Profit.